Hello and welcome everyone. Thank you for joining us for today's CH4B Expert Insights webinar on protection planning. I'm Kimberly and I'm the Head of Partnerships here at CH4B, where we help connect SMEs with vetted and verified suppliers to access expert advice and business solutions to help drive growth and resilience in your business. At CH4B, we're dedicated to supporting business owners with the knowledge, resources and expert connections that you need to navigate challenges and build a stronger future. Which is why we're thrilled to bring you this session today, focused on protection planning, an essential and yet often overlooked part of securing both your personal and business stability. We all know life can be unpredictable, but with the right protection in place, you can ensure financial security for yourself, your family, and your business. And to guide us through this, we're joined by Gemma Fitzer from CAPC Mortgages. Gemma is a highly experienced protection advisor specialising in helping individuals, families and business owners safeguard what matters most. And with expertise in life cover, critical illness protection, income protection and business continuity planning, she's helped countless clients put the financial safeguards in place. Today, she's going to be sharing her expert knowledge, some real life case studies and practical advice to help you make informed decisions about your own protection planning. So without further ado, I will hand over to Gemma and we can get stuck in.
Hi, my name is Gemma. I'm the protection advisor here at CAPC to offer you some protection services. We are a specialist mortgage and brokerage company, also specialising in protection, specialising in complex residential and commercial lending with detailed protection reviews. We are fully FCA regulated by the Financial Conduct Authority. We cover nationally any mortgages or protection needed, predominantly working with accountants, solicitors, independent financial advisors and wealth managers. The services we offer are residential mortgages, buy-to-let mortgages, commercial, development finance, and of course protection that I do, and everything in between. The protection policies that we're going to cover today are listed as the following: life cover, critical illness cover, income protection, family income benefit, business protection, relevant life, key persons, shareholders protection, and also importantly, trust and future planning. So firstly on the list was life cover. Now, this is a type of insurance that provides cover on death or diagnosed with a terminal illness. Now, usually a lot of people have this in place to clear their mortgage or provide a lump sum to their families or their spouse. The types of cover are level, RPI and decreasing. Now, level cover means that, for example, if you have a mortgage for 200,000 over a period of 20 years, even if you go down in the years, so 10 years later, you've got 50,000 left on the mortgage, you will still have 200,000 left in life cover. So it doesn't matter what year you were to pass within those 20 years, you would still have 200,000. RPI, which is a retail price index, goes up with inflation. Not a lot of people have this for life cover. It's very unusual to have this with life cover. However, it is an option. So this means that your payment received rises with inflation, but also so does your monthly payments. Decreasing, this means that if your mortgage is 200,000, for example, and you've got 10 years down the line, 50,000 left on the mortgage, you will only have 50,000 left on your life cover insurance policy. So it goes down in line with your payments of your mortgage. Okay, but please be careful on a decreasing. If the mortgage rate is over 8%, a lot of providers will only cover up to 8%. So if your fixed rate is, God forbid, 9%, you will have a shortfall at the end. Okay. Usually life cover is going to be the cheapest protection option. Critical illness cover. Now this provides a lump sum or percentage. This cover is extremely important, especially if you are off work due to being critically ill, because it's paid out on diagnosis or defined illnesses. The two types of cover you can have is core or upgraded. We never advise the core because it's very minimum medical conditions it offers. So, for example, it might be heart attack, but it has to be a really serious heart attack, and there will be different conditions attached to that. So we always say the upgraded conditions, the upgraded cover. Reason being is it can cover a lot more medical conditions. For example, a less advanced cancer, less advanced breast cancer, anything like that, you could receive a 50% payout of your critical illness, whereas the core one, it wouldn't cover that type of cancer at all. It also would cover things like if you went blind, deafness, due to being critically ill. So upgraded or a policy that is more efficient with additional medical conditions covered is definitely my recommendation. Again, the types of cover for this is level decreasing or RPI, the retail price index. We would always recommend RPI. Reason being is if you are insured for 50,000, because critical illness is more expensive than life cover because you are more likely to claim throughout the term. A lot of people just have a chunk of like 50,000 of the mortgage covered so that they're able to make payments, mortgage payments, while they're recovering, because covering the whole mortgage can be quite a large expense. So some people may have 100,000, 200,000. We always recommend on RPI basis for critical illness. Reason being is because 50,000 isn't the same now as what it was worth 20 years ago. So therefore the 50,000 would increase, and so would your monthly payments. But if, for example, it's for 4% inflation, it's not going to make too much of a difference to your monthly premiums on an annual basis. The other second option is level. People are quite happy with saying, well, no, I'm quite happy. I know the guaranteed payment that I'm going to pay every month. Decreasing, we wouldn't recommend due to the fact that, as you say, the amount of sum assured of the critical illness will go down over the years. So, for example, a client of mine had a critical illness cover. She told me she had 100,000, and when she looked, she only had 3,000 because she didn't realise it was on a decreasing basis. Income protection cover. Now, this pays up to 60% of your declared income at application. You can pay it for the types of cover that they come with is 12 months, 24 months, 5 years, or the full term. Now, what this means is, for example, if you are off ill due to accident or sickness, injury, with income protection, if you pick, for example, a 2-year, a 24-month one, you pick your defer period. So the defer period might be 3 months because your work are going to pay you full pay for 3 months. So you're not going to need it straight away. On the 4th month, your payment kicks in 60%, and then it will carry on paying continuously for 24 months. Then after the 24 months, you can go back to work before then, but after the 24 months, you then go back to work or find another job. And what will happen is if something happens again down the line, say 5 years' time, you are off work due to accident or sickness again, the 2 years and the deferred period kicks in again. So it's a continuous cycle of cover that you will have. Up until the age of 70, or 65 in some jobs, just depending on your jobs. When it says or term, this means that there isn't a break. After the 2 years, it still carries on. It carries on for life. So you could be constantly being paid for the job that you're now unable to do up until the age of 65 or 70. Types of cover for that, again, are level or RPI. RPI is obviously with the wages and income is recommended. However, if your job increases in wage, what we would do is by a big amount, we would then re-look and review your cover, because we always want to make sure you have enough to cover those utility bills and your ongoing financial commitments. So if you were earning 20,000 when you first took out the policy and now you're earning 100,000, that 20,000 policy is now no good for you. We need to have a look at one that's more substantial for your financial commitments. Okay. Family income benefit. Now, this can provide a lump sum or monthly payment to a spouse. It's paid on the event of death. So, for example, if your spouse has little ones to look after, what will happen is, and you take your policy out over 20 years, and in the 10th year, you passed away, and you wanted that money to cover until the children were of an independent age, say till the age of 21. What would then happen is you would receive the remaining 10 years of payments, however much your spouse has chosen to leave you. So you could receive £2,000 a month for the next 10 years. This is quite a cheap insurance to do, just making sure that your family is catered for, because you've lost that other income. This is cheaper insurance, as I've said, and it's cheaper than critical illness, and can be cheaper than income protection as well. Now, getting on to the business insurance, there's Relevant Life. Now, Relevant Life is exactly the same as life cover. However, it's paid through the business, again, paid on death or terminal illness for any of the directors or employees for their families. It's an allowable expense by HMRC, and it is quite tax efficient. Speak to your accountant about that. And it is placed in trust on application. So that employee knows that the beneficiaries from that insurance policy is going to be their families. It's also quite an incentive. So a lot of people like the fact that they have an insurance policy with their company and business that they work for, because it's kind of like a death on service. Key persons. Now, this insurance is to protect the business and its key individuals for life and critical illness cover. And this ensures minimal financial impact on the business. The business pays for the policies. And for example, if you have got a key person that works for you and generates a lot of income for that business, you would like to have them insured to make sure that if something was to happen to them, you have got the funds to carry on, train new key staff in the event of them being ill, and the business is actually paid this money, so it goes into the company account. Shareholders protection. Now, this policy is paid in the event of death or illness of a business shareholder. So typically used to purchase their shares so their families do not remain tied to the business. With the shareholders, if their shares are to go to their wife and their wife has, for example, no interest really in the business, or you don't want them to have any interest in the business, then this insurance is put into place with a cross-option agreement. Speak to a solicitor regarding a cross-option agreement. This means if you want to buy those shares, the the wife has to sell them to you, and vice versa. So if she wants to sell them, you also have to buy them. And that is a cross options agreement. It is also a business expense as well, and this just protects the business on a whole, if with the shareholders, and gains control of the business as well. Trust and future planning. Now, this is really important. The policies that are placed into trust will ensure that the beneficiaries are paid out within unduly time. So this means you won't have to wait for probate for months and months on end. Can take a year to 18 months. You will be paid within weeks or a couple of months on this. Trusts are very important, especially if you're not married and you wanted to leave those funds to somebody. However, you're not married. This is put in as a beneficiary. The claims are paid outside of the estate. This means they don't class as part of the IHT. And you can change the beneficiaries and trustees whenever you wish. This is called a discretionary trust if you did want to change any of the beneficiaries or trustees at any point. Also with this, we always advise everybody to update, review, change their will with all their future wishes into it, because this is also very important. The trust you are the settlor, and there is trustees and there is the beneficiaries. So I am the settlor, I have the insurance policy. The trustees are the people that I trust to give the money to the beneficiaries, especially if I have children that are under 18. I am trusting them to make sure that they are looked after. It is advisable to have 2 trustees. However, I think you can have, on some of the cases, up to about 6 to 8. So you can have quite a few trustees and beneficiaries on that, but it is very important. So thank you very much for your time, and I hope this helps.
Thanks, Gemma, and thanks for a really great session sharing your insights on protection planning and how to safeguard income, business and loved ones. It's a really, really important topic that doesn't really get discussed enough. We'll be sending around an email shortly with a link where you can request a meeting with Gemma. So if you've got any further questions or you want to discuss your individual circumstances, Gemma will be more than happy to go over that with you. Likewise, if we at CH4B can offer you any further support outside of protection planning, then absolutely feel free to get in contact with us. We'll always love to have a chat with you. I'll pop an email address on screen here, and you'll be able to email that anytime to be able to request support or book a call with one of our team. For CH4B members, this webinar will be recorded and will be available in the Members Hub for you to be able to watch back anytime. And of course, if you've got any questions, we're always here to help. Thanks again, everyone, for being here, and we look forward to seeing you again at more CH4B events. And we've also got our networking, which is free and open to everybody to attend as well. So hopefully I'll see you there. But for now, that is all. And again, if I can offer any help whatsoever, then just feel free to reach out.